Here we go again. I'm so excited. From the road. The first time I've ever done a one-on-one from the road. And who better to
Wow.
bring on here than someone else who's on the road? You get a 2-for-1.
Absolutely.
Garth
Absolutely.
Graham, senior partner at the Stratmor Group. It is great to see you, Garth. Last time I
Thank
saw you, we were sipping some cocktails at a local establishment in your old hometown of Vienna, Virginia. It's nice to
you.
see you again a month later.
That is 100% accurate. That is true. I was
That
in
was a
Vienna,
good,
Virginia, now in California. So, it is a coast to coast experience there.
that was a good meal too, wasn't it? You'll be
Yes.
back
Yes,
there.
it was. Yes, it was.
It's great to see you. Thanks for being with us.
Thank you, sir.
Yeah, let's jump right in here. So, you've been at the Stratmor Group for well over a decade now. Just
Yep.
real quickly, I know you as someone that is in the middle of a lot of deals between mortgage entities, but I know you do so much more than that. So, kind of a big overview into the Stratmor Group, what you guys do, and how we should look at you and your
Yeah,
firm.
sure. Awesome. Yeah. So Stratmor is a consulting firm for the mortgage industry. We operate only in the mortgage industry. So we're all mortgage bankers, ex-mortgage bankers, experienced mortgage bankers. We do a lot of strategy work on behalf of lenders. We partner with the Mortgage Bankers Association with the peer group programs. Often when you see the data coming out regarding cost produced, things of that nature. We do a lot of tech related work. And we do M&A work and acquisition work, or deals as you refer to it. But that is episodic, and it's episodic because it's kind of, and I could share the stats, but it's episodic from an industry perspective. Some years there's a lot, some years there's a little. And, we're sort of in one of these cycles right now, going from a lot to a little, I think, over time.
Yeah, so let's take a look at some of the stats because I
Yeah,
know
sure.
that not this past year necessarily, but the year before that and the year before that were epic, weren't they?
Yeah, yeah. So I'll give you a little bit of historical. In 2018, which was the bad year before the good years, if you recall, mortgage companies bumped along, didn't make a lot of money in 2018. It was a tough year for those of you, who've been in it at least that long. And there were 33 M&A transactions, an M&A transaction being defined as one entity buying another. It dropped to 15 or 13 in 2020. So, like a third as many when the market was good, and then started coming back. There were over 100 companies sold between 2021 and 2023. So over that 3-year period, it actually hit a peak in last year of 38 transactions completed. I was thinking that last year we might hit 50. That was my forecast. And frankly, we were short of that. There were less companies done, transactions done overall. Year to date, right now, we're at 15. So the pace for 2024 is certainly beginning to slow. But we're still above the big year of 2020 when there were only 13 transactions done. So, it gives you some idea we're beginning to slow, and we're slowing in some cases. This is a good sign that the typical average mortgage banker is now profitable after 8 consecutive quarters, 2022 and 2023, first quarter of 2024, the average mortgage banker was not profitable. And that creates pressure on independent mortgage bankers to seek alternatives. And in some cases, those alternatives are exit.
Yeah, so when you projected when you came up short last year in projections, was that based on what was in the pipeline and things just deals fell apart, or is that just you were sort of looking into your crystal ball and anticipating based on market variables?
Well, what is interesting is there's not been as much pressure from counterparties to force exits. And most notably, this is warehouse banks. So if you lose money 8 quarters in a row, a warehouse lender, typically you may be in covenant violation or at risk. And certainly the warehouse banks really control your ability to stay in the business. Without them, you're done. And they did not put as much pressure to lenders to exit. I think because the market was so small, they kind of liked the volume, and as long as you had the net worth still in there, and a lot of companies did coming out of 2020 and 2021, they sort of let these lenders limp along. I do think there's a possibility, and when we've talked to some of the warehouse banks, they've intimated, we have a watch list and we're ready to execute on it. So right now, the majority of mortgage companies are making money in the second quarter, so that's a good thing. Q4 could be rough though, again, depending on what interest rates do. So the refis might bail us out a bit. But if you're an independent mortgage banker and you're not making money, or you're not making a very good hurdle rate, at some point the warehouse banks will, when the market improves, may begin to lose patience and limping along with companies that aren't profitable or aren't well capitalized.
You wonder if they just look the other way because it was applicable to everyone. So
Exactly.
if you hold folks to the covenants, pretty much everybody, with the exception of a handful of lenders that maybe have servicing, would have been history, and that's not good for the marketplace, right?
Yeah, I think that's right. But they certainly all have watch lists, and they'll begin to execute those watch lists over time. I mean, I think one of the other trends, of course, we're seeing is the market, the number of lenders that fit into segments that are, viable origination segments is going down. And I'll give you kind of another statistic on this. There's less than 150 companies, IMBs, that are did over $1 billion in the last 12 months. It's 150. So if you're like, okay, was that high or low? Well, it was 350 in the peak periods of 2020, 21. So we are down 70% the number of companies that do at least $1 billion. And if you want to feel about it, a different way, do it at 2,500 loans a year, because that $1 billion, it would be even less if the average loan amount wasn't so high. So if you said, okay, 2,500 units a year, couple hundred a month, 162 companies, and this was 381 at the peak. So there's certainly, as far as relevant independent mortgage bankers that do at least enough volume that they can probably consistently cover their back office expense, their corporate administration expense, it's really like 150 some lenders. The other ones are pretty, that you're in a pretty small, and it is tough to maintain the cost of being an independent mortgage banker if you're not doing 2,500 loans a year or $1 billion in production.
So you think that, reading between the lines, it sounds like you feel like the industry could still be on thin ice, depending on what happens in the third and fourth quarter, especially.
Yeah, well, and I have two theories, and I'm happy to sort of go into it. But the two theories of, hey, we could be on thin ice. Many are saying, well, unless we get a refi bump, and others say, well, unless we get a purchase bump. And my warning is, while both of those things are likely to occur, and both of those things are good on balance, I'd be very cautious that they'll bail us out in the ways they have in the past. So I don't know if you want to kind of jump into that, but
yeah, no, you wrote an article a little over a month ago that you published on Stratmor's site, I believe, and it was disseminated around the industry, talking about refis and how the boom is not going to be what most people think, because what most people think is based on the past, right? What has the experience been? I've been able to refi half my book. It's good. We can count on that. What went into that calculus? Tell us about the piece that you authored.
Well, so I really looked at three different things. The first one is, in the last refi boom, over half of all refis were done by consumer direct shops, over half. So the consumers are saying and voting with their feet, they're willing to do it through a call center. It doesn't, by the way, mean, it's certainly not 100%, but it was half. Now, in the last period, we also absolutely hit an overcapacity problem. So of the half that went consumer direct, the other half may have been seeking out local alternatives or generating online leads that got sold to online mortgage companies or sold to retail branches. But in any case, because it was hard to get someone to answer the phone or respond to an application request during the boom periods of 2020, 21, as we're chasing 2-3% interest rates, it was only half. Well, this year, the aggregators in the last year have bought so much of the volume, the large correspondent aggregators, and they're sitting on consumer direct retention shops that are pretty idle up until right now. So, will it be at least the half? It could be higher. And by the way, before anyone says, hey, the whole world's going consumer direct, that's not what I'm saying at all. The same statistic on purchase is 15%. It's only 15% of purchase loans go through consumer direct. So retail people feast on purchase, which is great. I mean, that's what's, a good retail loan originator in local market and having relevance with realtors, that's their bread and butter. But it doesn't mean they're necessarily going to get a ton of refis when the refis fall in their lap. So I think that's kind of the biggest item. And then the second thing is whether or not the trigger lead, restrictions kick in here. Because a lot of times during the last boom, you could, if you said, hey, I want to do some refinances, you could buy new customer acquisition trigger leads. Well, I think that's going to be problematic because, it appears that we're heading towards, at least the MBA is working towards trying to create some sort of legislation that would make it only a servicer or the bank that would be able to maintain the relationship for which that trigger lead, would be permissible. And I think the other thing I would say is while mortgage companies successfully close loans and feel good about that, and loan officers can be very relevant to their consumers, meaning the consumer likes the loan officer. Our research, because we do surveys of closed loan borrowers, almost 50% of them say the experience was subpar in some way. They may still give a high review to a loan officer. They may say, hey, I liked you and we're happy that we closed, but the process wasn't great. I was asked for a lot of documentation. I was asked for too much documentation. I was asked for the same information more than once. Nobody called me before closing. Those figures still confuse me. Now, this is not tragic, but what it is this is why the vast majority of consumers do not get their next loan with the same people they got their last loan from. And we just keep as an industry doing this over and over again. We don't do raving fan service, which means the consumer might seek out an alternative the next time. So I think those are the three things I would say that impact, is the refi boom really going to help the independent mortgage banker who didn't retain servicing in this next cycle?
Well, you can mitigate that by paying attention. Always be recruiting your own, just sort of like within your own organization as a mortgage entity and an IMB. Always be recruiting, right? We spend so much time on the outside trying to bring people in that we often forget about the people that are in here now doing great things. If you apply that to your past closed loans, it's sort of similar, right? But the business that we've come to know and grow is the business oftentimes that's ahead. We're so focused because we're only as good as our last month. There's not a lot, of folks within organizations looking that way, right? Everyone's looking this way. And technology is going to change that. And the amount of servicers that have these loans and the amount of attention that everything is changing. The game is changing. I want to talk to you about, in your capacity as a senior partner of the Stratmor Group, roughly speaking, how many deals, has your firm been a part of? You have a rough number over the last, I don't know, you name it. You apply it an amount of years. Some level of involvement of, there've been 500 deals. You've had a hand in 400, something like that.
Yeah. So let me put it to you this way. The vast majority of people we talk to about what their strategic alternatives are don't do deals. So that's one thing I want to make clear. When we talk to independent mortgage bankers, we're not solely investment bankers who sell mortgage companies. We're strategic advisors to mortgage companies for which a sale may be an option. So we talk to way more. Our pull-through is small because many times the lenders say, okay, I appreciate the analysis. You did a custom benchmarking for me. You've illustrated my strengths and weaknesses. You gave me 5 things I could focus on. And you know what? I'm going to pick these 3 and I'm going to execute on them. And that's a very rewarding outcome for us as long as we're helping independent mortgage bankers, be better. In some cases, certainly dozens of times we go into, the potential sales cycle and complete those. The one thing I will say is I am most satisfied when a deal is transacted for which there is no announcement that ever names us as involved at all. And the reason is because we try to keep the announcements out of the press, out of, the columns, out of the press releases. And the reason is because it's really about the individuals at a mortgage company feeling comfortable about their new home and those two parties engaging with each other, cultural fit, and trying to ramp up. Like you said, hey, you're always recruiting. Well, in a M&A transaction, you just recruited 150 producers overnight. So the work should be focused on them, not focused on getting it in the press. So we try to stay, frankly, under the radar.
Yeah. So having owned a mortgage company myself and rolled up under NFM 15 years ago, I can speak to what it's like to have to roll up under someone that just has more than you, and economies of scale and things of that nature. And quite frankly, even though I do have those moments, and I think every owner does, where they're like, what could have been, best move I ever made, because it was 2009. I didn't have my full legal, NFM did, and it was I just felt like it was the right thing to do to take care of my people and protect them. What I'm curious to know, Garth, is why don't deals work out? What are some variables that come into play that deals that make sense on paper, just for one reason or another, don't end up working out? What are some of the variables?
The biggest one is cultural fit. And everybody says the culture is important. Everyone says their culture is great. And because, have you ever heard anyone say, well, I'm pretty successful, but the culture at my company is not very good? No, of course not. The difference is the cultures are different. So we actually have a process, sort of an evaluation process, where we ask 26 questions that try to quantify culture. Because culture is, hey, going to dinner. You and I had dinner the other night, and of course it was a good event. But culture means, what is the model? Is it P&L or corporate? If it's a P&L branches, how are they managed? If it's a P&L branch and they're negative, how is that handled? If it's a P&L branch and it's positive, how does that, does earnings get accounted for or distributed? How aggressive is the one company on product versus the other? How centralized is operational control or not? These are all elements that can be quantified. So part of our role is trying to quantify culture beyond just breaking bread with someone and liking them. So that is the biggest reason they fail, is culture.
Well, let's flip it around. Yeah. What are some reasons? What are some tea leaves that, if you're an IMB listening to this right now and you're sort of in the back of your head, you're like, man, I might be better off jumping on the back of someone that has the things that I don't have. It just might be too steep of a climb to get there. What is your message to those people, and what does that look like?
Given that, let's put culture off to a side, because just like culture can be the negative, can be the positive in the glue.
Yeah, of course.
So assuming you have a good cultural match, if a buyer has invested a significant amount in real estate, in technology, in operational excellence, provides really good service, and normally that means they spent money, really good capital markets, maybe execution. They've spent money, and it's money that you as a undercapitalized seller may not be able to do. So suddenly, and it doesn't mean they've necessarily built proprietary LOS or not, although that's pretty sexy too. But it could be that they've pieced together the technology elements better. They've got very good technology people that help drive it. They have good marketing tools. Your influencer division is super interesting, Greg. Not a lot of people can spend a lot of money to do that. That sort of production and that sort of focus. Those types of elements, if you're bringing them to the table, that means this production, should be sticky, and the seller should be able to do more business and thus likely make more money under the umbrella of the larger organization that brought them these capabilities than they would do on their own. They're obviously giving something up. They're giving up the percent of the net profit in the form of an earnout. They're giving up control, but they're also getting their capital off the table, reducing their risk. It may be life-changing net worth money for them and their estate. There's all sorts of benefits.
Giving up a lot of stress too. You're giving up a lot of stress. It's to have been there. Yeah, to have it all on your back.
And if they're bringing some goodies, then you could focus on, if that's your role, I'm helping my salespeople be even more successful with all these goodies that the new parent, the buyer, has brought to the table.
There's been a lot of consolidation. I know you don't want to go into names, and we're not going to do that. I promised you that we wouldn't. But should we expect the companies that have been on the acquirers to
Mhm.
continue on the road that they're on? You know, the names that we've heard, and
Mhm.
do you expect that those entities that have been the ones that come to mind over the last 2 to 3 years that have been gobbling up companies, that they'll still be the ones sort of leading the charge, or do you sense that someone might come from out of nowhere and start to play a role?
Certainly, yeah. So over 80% of all the transactions that have been done over the last 3 years have been a large IMB buying a smaller IMB. It is your classic consolidation. Over 80%. I anticipate it'll stay the same. The deals we have in the pipeline all fit that same model, and the pipeline remains pretty active. The only thing I will say is new money does come into it when there is a clear perception that we've hit the valley and perhaps the market's getting better. So we have had and are having conversations with, investors who are saying, I am interested in joining, entering the market. In some cases, that is, perhaps a fintech, it is a real estate firm or builder or something, in some cases has some sort of investment thesis. And in their case, they bring some goodies to the table,
Yeah.
something. And a year and a half ago, that was a pretty contrarian bet because 80% of mortgage companies are losing money. Now it's a better bet. So there are some newer entrants, and I think some of them could be headline worthy over the next 6 months. But it is traditionally still, over 80% is large IMBs buying small IMBs.
So before we wrap up,
Yeah.
the idea of push button get mortgage scared a lot of people back in the day. You know, this idea that this huge entity was going to come in with unlimited funds, and consumers were just going to hit a button and all of a sudden the mortgage would get done, and we'd all have to find something else to do. That didn't really happen like that.
Mm-hmm.
But we are in the middle of a transformation. It feels like technology is here. It's here to stay. AI is being integrated on most of our platforms. I want to just get your 10,000-foot view on the mortgage industry, and what role technology is going to play, and then what role is the belly to belly going to play? Is there always going to be an element of going out and meeting? In our settlements, another example is something that's historical, I think, in nature and the way things are
Mm-hmm.
changing. How do you sort of shake it all up and come out with some kind of a thesis?
Yeah, well, I think I just wrote and you referred to my article I wrote a month or so ago about refi, and people can get that off our website. I just wrote one and just released it on purchase. And it's a similar theme. Like, is this increase in purchase to what extent is it going to help an independent mortgage banker? I think the NAR settlement, we don't know exactly what that's going to be, but you can definitely, and I write about this clearly in the article, you can definitely extrapolate and say, are there too many realtors and too many loan officers in our market? Because for the most part, our market is 100,000 loan officers, or roughly 80 some thousand now, but let's round it off, keep the math even. It's 100,000 loan officers chasing 1 million realtors chasing 3 million deals. That's the funnel. And if you do the math, there's a whole bunch of small, part-time realtors who do 3 to 4 deals a year. And if you had relationships with 10, 15, 20 of them, and they give you a chunk of their business, you can survive. Well, if suddenly those realtors that are part-timers aren't doing 3 to 4 loans 3 to 4 deals a year because the co-broker model kind of is broken or changed through the settlement, you could pretty quickly come to a conclusion. You don't need half the realtors, and you probably don't need thus half the loan officers to chase them down either. So the biggest potential disruption I see in purchase is because of that NAR settlement. It could dramatically change the number of participants because the model is different.
Well, and that affects IMBs too. So,
Big time.
like for us, half our, roughly, I would imagine half of our self-generated business, of which, our company is comprised of mostly self-generated business from realtors and alike. I would think that 50% of them probably come from a very small amount that send us all of their business. And then the other 50% is a smattering of those agents that do 1 to 3 a year. And what happens if they all go away, right? Or what happens if half of them go away? And why would they go away? They go away because they've got to do much, much more work for much, much less money. And they were already just hanging on by a thread. So when it comes time to renew in January, it's going to be an easy choice for many. And so if we are looking for staring down the barrel of the 50% that's now been 50%ed half, right? Then that's a problem. It's a really significant problem. I know you and I see eye to eye on that. We talked about that.
Yep.
You know,
Yeah, I think you got to be very, very careful if your business is based on getting a little bit of business
from a
from
lot of agents.
realtors, from a lot of agents, or you're getting a lot of your business from agents who are in that, 3 to 4 year.
Yeah,
The
what
data is
amazes me
available.
is people that think nothing's going to change. I mean, there are people,
Yeah, I don't get that.
some very big, powerful names in real estate and mortgage are saying, much to do about nothing. This is just going to be business as usual. I don't understand how they could come to such a conclusion.
Yeah, and I think it's what's your horizon? Is this going to change things in the next quarter? Probably not. But like you said, there's catalytic events like January's, and when you have to relicense, or we're in the strategy business at Stratmor. Strategy is typically a longer horizon. Are you positioning yourself for the future? It's not, is it going to change next month? Here's a new addendum you need signed before you go look at an open house for a buy-side agent to recognize the fact they make a compensation. A little bit of the bridge to what is the future. And hey, maybe it's not going to change dramatically that fast, but I think it's going to change because
This has been great.
Too many agents,
This has been great, my friend. I promise everyone to keep this under 20 minutes. I haven't hit it yet.
Holy
This
cow.
is the fourth or fifth one-on-ones, and we're at 27 minutes. So I think I have to say goodbye. Did I forget to ask you anything? Is there anything you want to add?
That was awesome.
Yeah?
No, it's good. And by the way, you didn't say where the hell you were.
I'm in Nantucket.
Oh, nice.
I'm in Nantucket. Yep. I had our president and COO, Bob Tyson, who spends a lot of time up here. He invited me to his country club for dinner, me and my wife. And so we went to dinner about 6 weeks ago. And I was getting a free crab cake. I love the crab cakes at Congressional Country Club. And my wife's like, Bob, where should we go on vacation? We have a little window. And he's like, go to Nantucket. So that was the most costly free crab cake I've ever had in my life. Don't even get me started on what this room costs. But, it motivates me to work even harder. Love this business. I know you do too. We've been in it for so long. And this too shall pass. It has to. It always does. So I'm looking forward to seeing what's on the other side and, fighting like hell to be a survivor.
All right, boy. I appreciate it, Greg.
Yeah, appreciate your time. Garth Graham, Senior Partner, Stratmor Group. We will see you soon. Appreciate everybody. Next week, Jennifer Beeston, who is the #1 VA lender in the world. She works for Guaranteed Rate. She's going to be with me to talk about the NAR settlement and how she plans on surviving. She's closed 500 transactions in the last year in the face of 7 and 8% interest rates. So we'll see here next Monday at 1 p.m. Eastern time. Garth, so long. Thanks so much. We'll see you soon. All right. Bye-bye now. Enjoy your week, everyone.